Hey everybody, Raul Shah, Doc Shah Financial, and in today's video, I'm going to show you how you can build an inflation-proof retirement portfolio. So first of all, we're going to get into what inflation is because it's always misdefined if you go and look online. But inflation is not a rise in prices. That's actually a consequence of inflation. Inflation is an expansion in the supply of money. Just very quickly, some economics. Prices are set via supply and demand is measured in dollars. And so if you print a lot of money and give it to people to spend, well then that extra demand, those extra dollars, winds up bidding up the price of all goods and services. That's why prices go up. So inflation isn't the rise in prices, it's the expansion of the supply of money, and that is what causes prices to rise. Now, the CPI, which is the Consumer Price Index, is what measures inflation. The problem with the CPI is that it's wrong. It actually understates inflation by a very significant amount. The general rule of thumb is to take the CPI and double it if you want to get the real rate of inflation. Now, why does the CPI understate inflation? There's really three main reasons. Number one is substitutions. Let's say that the price of Lucky Charms goes up a lot, but the price of Cheerios doesn't. Well, they'll just take Lucky Charms out of the calculation and replace it with Cheerios. Now, this is a bit misleading, and by a bit, I mean it is misleading, because if you just take out the things that go up in price a lot with something that's equal, well, it's not really fair because not everybody wants to eat Cheerios. You can't just kind of pick and choose like this when it's convenient. And the second way that they understate inflation is through hedonics. And so essentially what that means is they're comparing quality versus price. So let's say that the price of a laptop goes up, but the quality goes up. Well, they'll just neutralize it and say the price hasn't risen because you're getting more value for the price. They try to equalize it, except it never works in reverse. And so let's say that the price of something stays the same, but the quality falls. Well, they just say that price hasn't changed. They don't actually say that, hey, it's actually gotten more expensive, relatively speaking. So again, they pick and choose to make the CPI look smaller. And the third way is through exclusion. So they just don't include certain things. So they don't, maybe include tuition, or, the way they calculate housing prices and rent is a little bit wacky. And so there's all these different ways that they manipulate the CPI to get a lower number. Now, that's not the point of this video. The point I'm trying to make is that the number is, generally speaking, smaller. And really, if you want to get an idea of what inflation is, you got to double it. And so when you look at that in the context of your portfolio, if you assume inflation is 2.5% a year, well, then it's really closer to 5% a year. And that makes a huge difference in your retirement calculations and what your withdrawal rate should be when you look at that over the course of your entire retirement. So 10 years, 20 years, 30 years. The difference between a 5% and a 2.5% inflation rate is huge. And if you mess that up, you're going to wind up with nowhere near enough money to make it through your entire retirement. So let's actually go through an example here. And I'm going to show you what the purchasing power is of $1 million at 5% inflation a year for 20 years. And I think you might be a little bit surprised. All right, so as you can see, if you had a $1 million portfolio today and inflation was 5% for 20 years, your purchasing power in 20 years would be $376,000. One of the tricks that inflation pulls on you is that your principal balance never actually changes in front of your own two eyes. So if you start your retirement with $1 million, and let's just say you're living off the interest, call it 6% a year, so, $1 million, you make $60,000 a year, you live off that. And the next year, you still have $1 million, generate 6%, you live off that, and so on and so forth. In 20 years, your principal balance will still be $1 million. But the purchasing power is significantly reduced to pretty much about 1/3 of its original value. And so it's very tricky because in front of your face, you're seeing $1 million in your brokerage or your bank account, but the money's not going as far. In fact, it's going 2/3 less as far than it would have otherwise. And so if you want to prevent this, you have to be able to beat or at least match inflation to maintain your purchasing power so that your $1 million portfolio today is still worth $1 million in the future. So how do we do that? One of the ways that I like to do it with clients is buying really good individual stocks in their accounts. And so I'm going to actually walk you through how I value invest and what are the things that I look for in stocks and how I would actually set up a stock in a client account. Okay, so we're going to take a look at Williams Sonoma. This was a stock that I bought for many clients. We don't have this in client accounts anymore. And by the way, this is not a recommendation at all. And I also want to point out this is FastGraphs. It's a really wonderful fundamental analyzer tool. I'll go ahead and leave a link in the description if you want to use my discount code. But let's go ahead and actually get into this stock. So the first thing you notice is this green shaded area, which is the company's earnings. And you notice the black line, which is the company's stock price. And you also notice that stock prices trade above the earnings, meaning the stock's overvalued, through the earnings, meaning the stock is fairly valued, and under the earnings, meaning that the stock is undervalued. And what most investors do is they buy when stocks are overvalued, like at this point in time, and then they sell when it becomes undervalued. And so over time, they're basically just destroying their capital. You can see in this example, you would have lost 46% if you bought in 2015 and sold in 2020. But the real trick to buying really good high quality stocks and how they actually combat inflation in a retirement portfolio is buying them when they're undervalued. So stocks are risky when they're overvalued. So during times like this, when it's over the green area, over the earnings, but stocks are generally pretty safe when they are undervalued, when they're under their earnings. And most investors don't have the discipline and patience to buy it in this area. And I bought this stock for clients, I don't remember off the top of my head, somewhere around here in October. And we sold out of these client accounts early in 2024. And you can see in this example about a 52% return in a very short period of time. And again, this is an extreme case. You're not going to always make 52%. You might make 5%. You might lose 5%. You might lose a lot of money. But the point I'm trying to get across is if you're disciplined and you buy stocks when they are cheap and undervalued, as in this example, and you sell it when they become fairly valued, you can make quite a bit of money, and you can actually combat all the adverse effects of inflation with a small percentage of your portfolio. So you don't need to take your entire retirement portfolio and put it in an individual stock. You can actually put a very small portion of that retirement portfolio in an individual stock. And if you buy it at a good price, you're going to make a good return, and that's going to immediately offset inflation. And I really want to harp on that last point. So a small part of your retirement portfolio in really good high quality stocks can make a huge difference. You don't need to take your entire retirement portfolio and buy individual stocks. Let's use an example. Let's say that you have $1 million portfolio and $900,000 is in a very safe, let's just say a fixed income government bond that gives you 5% a year. If you take that $100,000 and you buy an individual stock and make 10%, then your overall portfolio return is 5.5% that year. You just beat inflation by 0.5%, so you didn't lose any purchasing power. In fact, you gained purchasing power. So that just shows you the power of buying individual stocks and retirement accounts. Again, you don't need to go crazy. A little goes a really long way. And generally speaking, there's not that much risk, or not as much as you think, if you're disciplined and you buy the stock for less than what it's worth. And if you need help constructing this type of a portfolio with the professional's help, just shoot me an email, Raul@DocshaFinancial.com. I'd love to hear from you, and I hope you learned something from this video. Thanks again, and I'll see you next time.